Hey there, 10-minute traders. Welcome back to the How to Trade Stocks and Options podcast, where we give you the tools, tips, and tricks to help you trade faster and trade smarter. And today we have a special guest all the way from Germany, Stephan Haller. And today we're going to be going over his book, If You Can Order Pizza, You Can Trade, a mechanical approach to options trading. Stephan, thank you so much for coming on.
This is the How to Trade Stocks and Options podcast, brought to you by 10minutestocktrader.com.
Hi, Chris. Hi, everyone. Hi from Bavaria. How are you?
Hey, I'm really thrilled to have you on today. I found you through social media, essentially. I saw your book coming through a couple different times, and I thought, this sounds like the perfect guest for the How to Trade Stocks and Options podcast, because he's literally written a book about how to trade stocks and options. So, Stephan, please tell us a little bit about yourself, a little bit about your history, and tell the audience, what they can expect whenever they find a book like this.
So I live in Bavaria, near Munich, and I'm a teacher, a trade school teacher by profession. And I started to trade stocks, only stocks, when I was 16, during the great bull market of the 90s. And I found options about in 2010. And 6 years ago, I found Tasty Trade, and I absolutely loved it when I found it. But it was so much information, like drinking from a fire hose. I binge watched the archives, and then I immediately wrote Tom Sosnoff and asked him, "Do you have a book? There should be a Tasty Trade book." And he said, "No, there's no Tasty Trade book." And I always thought about writing one. And then I followed Tasty Trade. I traded basically like Tom, always with short deltas, contrarian. And it worked, but I had really big swings in my account. And then I started researching on my own. I did a lot of backtesting, trading mechanical, trading only delta neutral, and it worked out pretty well. And yes, I traded for several years, and then 2016 came along, and then I thought, I think Trump will win the election, so why not short the market? And I
well, hey, you got the election part right, but the market disagreed with you there.
Yeah, and I had a pretty big short position, and then because of the time difference here in Germany, so I woke up during the night and checked the markets and saw futures were down 70 or 80 points.
That's right. Yeah. In fact, for the audience, I remember looking at that as well, watching the election night coverage and looking at my phone, seeing the futures, and they were lock limit down, meaning that they are as low as they will go in overnight trading, and it's all bets off when they open the next morning. So yeah, I saw the same thing you did.
And then I didn't go back to bed and watch the markets, watch the election coverage, and I got happier and happier because at one point they were down 140. Before I went to work, I was dancing in the shower because I was so happy. And then when I came home from work and markets opened, because when I come home from work, it's always a time when markets in the US open.
Oh, okay.
Which is pretty cool for me because I can work full time and trade.
Yeah.
Yes, and then the markets opened and they rallied, and I adjusted my position the wrong way. I got shorter because I took away my puts. I rolled my positions, and at one point after several months, I gave up after losing a huge amount of money. And then I started writing the book kind of like a self-therapy.
Okay, that makes sense.
So throughout the years, I've always been in close contact with Tom Sosnoff. I emailed him a lot, and then I asked him, "What do you think? Can I write a Tasty Trade book? And especially, can I use this title? Because this title, if you can order pizza, you can trade, is a phrase he always used on air.
Right.
Said,
And real quick, would you mind for the podcast audience just explaining who Tom Sosnoff is? Because someone out there may not be familiar with him.
Yes, Tom Sosnoff is a former market maker at the CME in Chicago. He traded the S&P 100 options at this time, and he also founded Thinkorswim, the first, I think it was the first online retail options platform, which he sold, I think, in 2009. And after that, they started Tasty Trade, so an online TV station about trading options and futures. And everything I know, almost everything I know, I learned from him.
Yeah.
About options. And 3 years ago or 4 years ago, they even started Tastyworks. Definitely the best trading platform out there.
Is that what you use?
Yes, of course.
Okay. Yeah, that's what I use as well. And just real quick, we're going to plug them if you don't mind. I use Tastyworks. Stephan uses Tastyworks. And honestly, it's because we feel it's the best platform to use out there. So if you don't already have a trading account or you're looking for a new broker to go to, check out Tastyworks and make sure you use the code 10MINUTE. That's 10 MINUTE. And whenever you do that, when you open your account, I'll send you over $150 in free 10-minute trader exclusive bonuses. And all you have to do is open a Tastyworks account. So it's a win-win for you. You get free stuff and you get the best trading platform out there. So I'm glad to hear that you and I both share that opinion on Tastyworks and Tasty Trade. I also learned a lot from Tasty Trade and Tom Sosnoff. And in fact, I'm actually personal friends with Jim Schultz, Dr. Jim there.
Oh yeah.
He's been my trainer, my physical trainer for a couple of years now, and he's a really great guy, and that whole team is incredible.
Yes, I totally agree. And almost all the screenshots in my book, when I describe the strategies, are screenshots from the analyze page in the Tastyworks platform. So yeah, and then I started to write the book. It took me about 9 or 10 months to write it. Basically, it took me 6 months to write it, and the rest was just editing.
Yeah.
Because I never wrote a book before. I was totally novice, and I had a lot to learn. And I always stayed in close contact with Tom. I showed him my ideas, what I wanted to write, and he was actually he and Tony Batista were the first who got my book before I published it.
Oh, okay.
And then in late September last year, I published it on iTunes, on Amazon and Google.
Oh, so it's available on all those platforms?
Yes, and on Barnes & Noble.
On Barnes & Noble. Okay, so for the audience out there, I'm going to put links below, and you can have your choice for Apple Books, Amazon, and Barnes & Noble. Is there anywhere else?
No, just the four. So,
okay, perfect. So check out the links below for the the content there. And really, Stephan had 2 books. We've got the If You Can Order a Pizza, You Can Trade, and then he has the bonus chapters that go along with it. And honestly, Stephan sent me an advanced copy, and I really think if you get one, you need to get both. They really complement each other fully and completely. So all those links will be down below.
Great. So if you own an iPad, I highly recommend the iTunes version, because this book was designed for the iPad.
Oh, okay.
I wrote it on the iBooks. There's a free author software, the iBooks author software from Apple, and it's fantastic, a fantastic software, and it also works, of course, on the other platforms. But there's one problem with the Amazon version. The the links don't work.
Oh no.
They only. It's not my fault because they turned them off.
Oh, I see.
I was fighting with them over weeks because I demanded I need those links to work. And they told me they are working, but only if you are using a Kindle Fire.
Oh, okay. Well, that's good to know.
But you can copy the links and copy and paste it to your browser, and then you get the links.
Perfect.
Because I have a lot of studies in it, tasty trade studies, and then there's a link, and you can click the link and can watch the tasty trade video.
Okay, perfect. Yeah, so everything that is available in the iTunes version is available on the Amazon and Barnes & Noble.
Yes.
It's just one extra step for copying and pasting a link. Yeah. That's good. Okay, perfect.
In the Google version, everything works. In the Barnes & Noble version, everything works. In the iTunes version, everything works. The only problem is with the Amazon version.
Gotcha. Okay.
So, and there's an updated version. I worked the last weeks to update the first book.
Okay.
I added 3 chapters which weren't in the original version. It's available on all platforms. But if you already have bought it on Amazon, it will take 1 or 2 more days until the update is available.
Oh, it updates it automatically?
No, you get an email from. You should get an email from Amazon, and then you have to go to your account and update it.
Okay.
But if you buy it now on Amazon, you get the new version. It's only for the people who have already bought it, because Amazon has this kind of policy. They don't like it to update books, because when you have some notes in your books or something, then there's a chance that these notes you put in your book get lost, or bookmarks or something. And but I told them you have to update, because my readers have a right to these new chapters.
Perfect. Yeah. Well, great. Well, I'm excited that you've been updating it and keeping it fresh. That's awesome. So what Stephan and I were going to talk about today, I was going to go through the book. Like I said, he sent me an advanced copy, and we're going to go chapter by chapter. Essentially, we're going to find the highlights that I found interesting. Stephan's going to show some of his knowledge on it there, and basically we're all going to learn together, thanks to Stephan, who's a teacher by trade. So that's fantastic.
Yeah.
So the first area that I want to go to was the basics, chapter 3. And essentially it says here, options trading is a strategic investment. It's a numbers game. You trade probabilities. By trading options instead of stocks, you can decide for yourself how much risk you're willing to take and how big your chances of winning will be. So please expand upon that. I love trading options, and one of the reasons is the probabilities and the risk, the ability to size risk no matter what size you want it to be. So please expand upon that.
Yes. Trading stocks is always a 50-50 shot, but short-term trading, it's always a 50-50 shot. Nobody knows anything. I thought I know. I thought I know something. Yeah, I did. In the past, I did a lot of research about companies and read a lot of balance sheets and looked at charts and all that kind of stuff. But it is a 50-50 shot. Nobody knows anything, not even Warren Buffett. And and Warren Buffett trades a lot of options too.
Oh, does he?
Yes.
Tell us more about that.
It's always in the letter to his shareholders. I think Berkshire Hathaway makes about 1/3 of their profits with mostly selling puts.
Really? Wow. I did not know that.
And during the financial crisis, he sold a lot of very, very long-term puts, so about 10 years out or something, in the SPX.
Huh.
So this weren't. He did it not in the open market because these long-term options aren't available, but he sold this long-term puts to the big banks.
Really? Okay. So what you're saying is that you and the people who trade in this way selling options, things like that, are trading just like billionaire Warren Buffett?
Maybe, yes, some kind of.
I tell you what, if that doesn't get you excited about doing this, I don't know what does. I had heard that before, but I don't know if the people in the audience had. I mean, this is the same strategy that billionaires use whenever they're trading, and like Stephan was saying, he's not buying calls. He's not doing anything like that. He has a bullish bias to the market, and he's one of the biggest players in the market, saying that, you really just can't beat the S&P over time. So what he's done is he's sold puts, which is a bullish position. He's actually going to probably beat the S&P if you add all those puts up together. And I mean, that's an easy way to get started. Yes. And for someone like Stephan to be able to replicate a billionaire's portfolio in that way, I think that's pretty incredible.
I mean, even if you think you know something, I got beaten up. I got beaten up by the market so often,
mm-hmm.
and I'm thankful that I got beaten up by the market. Now I know I don't know anything.
Yeah.
But if you think you know something, even then it's better. If you want to go long Apple or something, don't buy the stock, just sell a put.
Mm-hmm.
And if the put expires worthless, sell the next one, the next
mm-hmm.
month. Rinse and repeat. And someday the stock will fall below your strike price, and then you will get put the stock.
Mm-hmm.
But this is what you already wanted in the beginning. You wanted to own the stock, but at that point you made it's basically you lowered your basis price, because you received the option premium every month, and then you are buying the stock at a discount. So
yes, in fact,
a lot of
you
people
talked about
always
this
say,
in the book.
Sorry, yeah,
I was just going to say you talked about this in the book, and that was
yeah.
one of the points I wanted to go over on this. But please continue, and then we can. I'm writing some notes down here.
Lots of people always say options are risky, but where is the risk? Let's say a stock trades at $100, and you buy it at $100, and it goes down to 90. And in the other occasion, you sell a put at $100 in the same stock and receive, let's say, $2 in option premium, which equals to $200 in per contract, and then the stock goes to 90. So the first person bought it at 100.
Mm-hmm.
You buy the stock at 98 because you already received the option premium.
Right.
So you lost basically at that moment when you get put the stock, when it is at 90. Your losses are $200 less than the
mm-hmm.
first person who bought the stock. But there's a trade-off. When you sell options, you have the higher probability,
yes.
but you give up the unlimited gains, the
mm-hmm.
unlimited profit potential. It's basic. I always say, and I write in the book, premium sellers are like the casino.
Yes, absolutely.
Then you can only make what the players are willing to bet. So it's predefined how much money you can make. When a gambler bets $100, this is what you can make. He only risks $100, but he can make whatever. Yeah, what he
right.
He can hit the jackpot.
Mm-hmm.
So the trade-off is he has a much lower probability to hit the jackpot. You have the higher probability, but limited profits. He has basically unlimited profits.
Right.
And yeah, in the end, who wins, the casino or the gambler?
Definitely the casino.
Yeah.
I don't see the gamblers going home building their billion-dollar empires, billion-dollar casinos. And, I think a lot of people, new traders that come into the market, especially, they see the gurus out there. I just saw one yesterday. I won't name any names, but he was posting he doubled his account in January. He's incredible. He's fantastic. And it's like, look, guy, don't play games here. We all know how the markets work, okay? The market went up 7% overall in January, which is a really strong month for January. Don't give me that you doubled your account in January baloney. And, new traders get lulled into that idea. The stock market is a lottery, right? I can buy this, and next month I'll double my account, and then the month after that I'll double my account again. I'm going to be a millionaire by the summer. It's really disturbing, the level of predators out there, really, and that's definitely not something that I do. It's not something that I share, and anyone who I interact with, I make sure that they're legitimate traders because they understand how markets really work, and they're not selling you on this pipe dream of, Stephan, his book here, if you can order a pizza, you can be a millionaire in the next 6 weeks. No, that's not what he's saying. He's saying you can actually learn to trade, learn what the market really does.
So trading the way I do, and probably you do, it's more like collecting bottles and cashing them in. It's thousands of very small profits.
Yeah.
But over time they add up.
Right.
Of course, somebody can double his account in 1 month, but he has to take so much. He has to take so much risk and has to use so much leverage. Then, if the market doesn't what he thinks the market does, he's out.
Yeah. And in a big way.
In my opinion, there are no gurus, because let's say you have 1 million people, and this 1 million people are coin flipping. And the losers go home, the winners stay, and then they flip again and again and again. In the end, one person will be left over, and he has won all the coin flips. Is he an expert in coin flipping?
No,
I don't think so.
I've never heard that, but I think that's incredibly great.
He could go out on the internet and could say, I won thousands of coin flips in a row. I'm an expert. In Germany, I know about 20 years ago, there was a guy who won the lottery twice.
Wow.
In 3 years or something. He gave seminars.
Oh my goodness.
How to play lotteries and what numbers are great and something like that. He made a lot of money giving this lottery seminars because he won twice, which is very unlikely, but it happens. These are the outlier moves, the black swans.
Right.
But he's definitely not an expert in playing lottery.
Huh.
So it really is a numbers game. Maybe in the time Warren Buffett started, I think you could have an edge with doing research. I read a lot of books about Warren Buffett and the other two guys, the intelligent investor. What is
Benjamin Graham?
Yes.
Yes.
In those days, the markets weren't so efficient like they are today. So you could have some kind of inside information or something. But in nowadays, all the informations out there are priced in.
Yeah.
And even the informations which are not out there are priced in the options. If you in one of the last chapters of my first book, where I show how to find the dividend in ETFs.
Oh yeah, I remember that.
Because it's in a single stock, it's pretty easy to find the dividend because the company says what the dividend will be. But in ETFs, nobody can tell you what the dividend will be because there are 500 companies in the SPY, for example. So it's hard to find out the dividend. But the stock, the options market can show you pretty much very, very exactly up to 3 or 4 cents what the dividend will be.
Right. And in the example in Stephan's book, chapter 19, how to find the dividend in an ETF, the example he gave was within 1 penny.
Yeah.
And that's pretty great. Now, as an options trader, why do we care about the dividend?
Because you only have to care about the dividend when you are short calls.
Mm-hmm.
Because when you are short calls and the call gets exercised by the other side of the trade, then you have to deliver shares.
Right.
You don't have usually, except if you have a covered call. So if you're a long stock and then sell a call on top of that, then you are covered. So if your call gets exercised, they take your shares away.
Mm-hmm.
So there's no problem. And you made a profit because you wanted the stock to go up to your short strike or beyond, and that's what the stock did. So congratulations, you made a profit.
Right.
But when you're short naked calls, and then you get assigned a short stock position, because you had to deliver 100 shares of stock per contract to the other side who exercised the call.
Mm-hmm.
And then when there's a dividend, you are also obligated to pay the dividend.
Yes. Now, I have an experience with that I'd like to share. So, to Stephan's point, whenever you sell calls, which is a high probability strategy in its own right, you are entering with a contract with the person who bought the calls. The person who bought the calls, let's say I'm selling them to Stephan here, and he wants to go long a certain stock. Maybe he wants to go long what pays a dividend? Not GE. That doesn't pay any dividends anymore. Let's say let's
Apple.
go with Apple. Okay, so let's say Stephan wants to go long Apple. He's buying calls. I'm selling those calls. I have a bearish position. He has a bullish position. In that way, he may decide that he wants to take ownership of those actual shares now. And when he does, if it's on a certain date, I actually am going to owe him the dividend. So my story with that is I had sold a broken wing butterfly in XRT, and I was not paying attention, and the ex-dividend came up for XRT. The next day I opened my account, and first off, it's negative $8,000. And I was like, What just happened? Wait a second.
Margin call.
What do you mean I'm negative $8,000? And then I see I had several hundred short shares in my account, and I was like, I didn't do that. And I was like, oh, there was a dividend yesterday. I didn't even realize it. So not only did I have to, well, first off, anytime you get a margin call like that, I never stress. I just close the trade. I mean, some people may stress and be like, oh my God, I have to mortgage my house. No, just close the trade. Move on through life. But yeah, I closed the trade, and then, which was really fantastic, and I'm being sarcastic here, I also then had to pay that person who exercised all those shares the dividend from my account. So knowing the dividend as an option seller is really important, especially if you're selling calls like Stephan's talking about here. Because the last thing you want to do really is wake up, see your account's negative $8,000, and find out, oh, geez, now I owe dividends on top of this. Yeah, it easily avoided, essentially. And Stephan talks about actually how to avoid that inside of his book here. And that's oh, go ahead.
Sorry, and I also talk about why the other side exercises his call. And I think this is one of the new chapters, why short calls get exercised. And I did it in a way I think it has never been presented before.
Mm-hmm.
At least
actually, I agree with you. I liked it.
I read a lot of options books, and nobody has presented it like I do, because I do it with a synthetic call position. So for people who don't know what synthetics are, you can, with options, you can basically build a long or a short stock position. So a long stock position is this, you can build a long stock position by selling an at the money put and buying the at the money call. Then you have the same position on, and like long 100 shares of stock. And if you sell the at the money call and buy the at the money put, then you have a synthetic short position.
Mm-hmm.
It acts totally in the same way like the long and the short position. So why would you do that? Because it saves a lot in buying power. If you buy 100 shares of stock, you have to lay out 50% of the actual stock price times 100 if you buy 100 shares of stock. And if you do a synthetic stock position in SPY at the moment, it is about $5,000 or something in margin requirement. So you save a lot in buying power.
Mm-hmm.
And then you can, so the formula is short put plus long call equals long stock position.
Right.
And this formula, then you can rearrange this formula. So a synthetic call position or a long call position is the same as being long 100 shares of stock and long an at the money put.
Mm-hmm.
So, and I know it's complicated, but in my book, I have a lot of pictures in it.
He does, absolutely.
It's easier when you see the pictures. So
I completely agree. I was one of the things I was actually really glad about was you did have all the pictures. In fact, I'm going to do a little preview for the audience here. I've got it up on my iPad. There's some pictures there. There's your preview of the day. But yeah, it's got a lot of pictures, and he's specifically talking about the synthetic long that I actually have up on the page here, chapter 8. And having all these pictures really helps demonstrate the points that he's talking about.
So when a person exercises his call, he gets paid nothing. Actually, he has to pay some fees, and then he receives 100 shares of stock. So if you have a synthetic call, which is a long stock position and a long put position, it would be the same. You have to throw away the put to have the same position on if a person exercises long call.
Right.
Both of you have 100 shares of stock. So that means if you have a synthetic call, you throw away the put for nothing, and this is the extrinsic value. So if a person exercises his call, an option always has an extrinsic value. So you have to pay a little more for an option than for stock because you have the unlimited profit potential.
Mm-hmm.
So a person who is long a call would only exercise his call when the dividend is going to receive is higher than the extrinsic value in his call, because he could just sell his call and then buy the stock. Then he wouldn't have to throw away the extrinsic value.
Right.
So
and that doesn't make sense really to just throw away the extrinsic value. I mean, financially sense, absolutely.
Nobody throws away money.
Right.
In the markets. Markets aren't stupid. So you always have to look at the corresponding put of your short call position and at the price, and then you have to know what will the upcoming dividend be, and if the upcoming dividend is higher than the price of the corresponding put, then your call probably will get exercised.
Right. And
this the dividend is built in the options markets. So how do you find the dividend? You just look at the synthetic long stock position. So sell a put, buy the call. In the weekly options, the day before the ETF goes ex-dividend, and if there was no dividend, then the synthetic stock position and the real stock position trade at parity, at the same price. And in the example in my book, the synthetic long stock position trades at a credit of 17 or 18 cents.
Right.
And this is not possible if there was no dividend, because then you could just open this synthetic stock position, and at the same time short the real stock, and then you lock in this 18 cents of profit, so $18 per 100 shares of stock, free money.
Yeah, which doesn't exist.
Yes.
I have my own free money story. It's similar to your example there. I got really clever one day, and I was messing around with an options chain, and I forget I think it was FEZ. And I was doing an iron condor, and I'm just moving strikes around, trying different things out. And I found that if I sold a call spread and sold a put spread along the same strikes, that it was a credit greater than the width of the strikes. Yes. And I was like, this is sweet. This is free money. So I'm executing trades. I'm going down on Twitter. I'm like, arbitrage alert, free money out there. Go do it. And someone hits me back and they're like, bro, there's a dividend. And I was like, what are you talking about? And they're like, there's an 80-cent dividend coming up. You need to exit this trade immediately. And I was like, jeez. So I had 12 contracts of that put on because I was just excited. I was like literally filling up as much buying power as I could. And only to find out that these were going to be immediate losers. And really, I was the loser for thinking that there was free money out there. I think we all have some experience in that learning experiences out there. And that's why, I really enjoy sharing these kind of stories with people because, hey, listen, if someone out there can learn from my experience and it doesn't cost them any money, I'll feel like I've done a good job today.
Okay,
so,
of course.
Yeah.
So I have the same similar story in my book, the Tilray. Sorry, the cannabis company. I'd never heard of this company, but I think it was on Twitter. Somebody tweeted out, you can do $10 white iron flies, so an iron condor, but with the short strikes at the money for more than the strike with. And then I checked it out. The mid price was for a $10 white iron fly was $9.99.
Oh, look at that.
And so only 1 cent in risk. So I couldn't believe it. But I tried it. And then I immediately got filled for $9.99. And then I got scared.
Yep.
Because I couldn't. There is something wrong here. So I Googled it. There must be a dividend. But there wasn't a dividend. So what could it be? So then I found out this stock was one of the most shorted stock out there. And when you short stock, when you sell stocks short, you have to lend. You have to borrow this. You have to borrow these stocks, sell it, and then you are hoping that the stock will go down, and then you buy it back cheaper, give it back, and book your profit. But you have to pay an interest on this borrowed stock
because you don't own the stock.
Of course. So there are people out there who have big stock portfolios. They lend out their stocks, and the interest rate on Tilray was 700%.
Oh, that's no big deal. Just 700%.
So there was a 100% chance that the owner of the call, who bought the call from me, will immediately exercise it because then he has long stock and can lend it out and can make a lot of money within a year. And because in this stock they're pretty wide, so I probably would have to pay up in the open market and pay the fee, the interest rates. So I was definitely going to lose money. So I immediately went back to the market and closed my position for a debit of $10.10. So I lost.
Okay, not so bad.
$11 per one lot.
Yeah.
Yeah, but it was a great learning experience.
Absolutely. Yeah, I love sharing stories. Really, I think that's the best way for people to learn. One of the stories that I share a lot of the time kind of goes back to the election, actually. Like you were talking about earlier. I had lost 2/3 of my account in the first 60 days of trading, and you're not going to find any online guru out there talking about that. That's because I'm a real trader. I'm not, fake paper trading anything. I'm actually doing this with real money. In fact, if anybody wants to go see what I'm trading, all you have to do is sign up for free access, and you can see every single thing I've traded in the last year out on 10minutestocktrader.com. And if you ever care to follow along with any of the trades I have a platinum membership, and I send out trade alerts through a WhatsApp and let you know, hey, I'm entering this position, I'm exiting this position, I'm doing this other thing. So anyway, thinking which way the market's going to go and really levering in can be really expensive when you find out you're wrong. I say a lot of the time that that 2/3 of my account essentially was the tuition I paid to learn how to trade, and I don't know any real trader who hasn't blown up their account at least once.
I did it twice.
Yeah, I have too. I think
so
maybe
if
a third time in there too, maybe.
If you are interested in my trades, I have I do a portfolio update every week.
Perfect.
On Steemit.
What is the link for that? And I will make sure to include it in the notes below.
The links to my social media are in my second book.
Mm-hmm.
It's Stephan Haller. As at Stephan Haller.
And that's on Twitter and Instagram
and Steemit.
Steemit. Steemit is it's a social platform?
Yes,
I didn't know that.
STEE Steemit. It's a blockchain based platform where you get paid for posting stuff.
Oh well, I need to go on that right away.
They have their own cryptocurrency, which is Steem.
Uh-huh.
And if the readers like you get likes like on Facebook, and the more likes you get, the more Steem currency you get.
Wow, I tell you what, that's exciting.
You can also invest in Steem. Of course, it's a cryptocurrency. You can buy it, and then it's called Steem power. The more Steem power you have in your account, so the more of the tokens you have, the more one upvote from you is worth. So there are people out there which have several millions, and if these people give you an upvote, it's worth $100 or something.
Wow.
So when the big bull market in the cryptocurrency in 2017, there were posts. I think the biggest payout for one article on Steemit was about $20,000.
Holy cow! Wow, I'm missing out.
At the moment, it's I on average I receive maybe $2 or something per article. So at the moment, because cryptocurrency price is so low all over the board, the highest price in Steem was about $8 per Steem, and now it's down to 30 cents or something.
Oh wow!
It's great because it's a blockchain-based platform, and I post every week a portfolio update. I don't give away my trade size, so all the trades, the screenshots, of course, I put in the screenshots from the Tastybox platform or run lots. But all the trades, all the trade managements I do, all the losses per one lot, all the profits per one lot. This
perfect.
is I post it every week, and my actual trades for this portfolio I posted on Twitter.
Mm-hmm. Well, very cool. I will make sure to link that below.
If you want to see how I trade,
Twitter.
Follow me on Twitter and Steemit. Yeah.
Very cool.
But you don't have to sign up on Steemit to read my portfolio update. That's not necessary. I always put out the link on Twitter, and then just click the link, and then you can read to it.
Gotcha.
But
well, perfect.
I have to say I'm a really boring trader. So
honestly, I think boring traders end up being the best traders because they can hold on to their money.
I only trade 5 underlyings, 5 or 6 underlyings.
Yeah.
Only ETFs. I trade IWM, FXE, so the euro currency, GLD, gold ETF, TLT, so the 20-year bond ETF, and XLE, the oil and gas
Mm-hmm.
service, because I would like to trade oil, but there's no underlying to accept the future
Yeah.
to trade, because USO has a built-in drag.
Yeah, and USO is so tiny; it's hard to get
Yeah.
really good trades in
Yeah,
there.
and it has this built-in drag because it consists of a portfolio of futures.
Mm-hmm.
I don't know if your viewers know, when you roll futures from one month to the other, there's futures are usually in contango, though the
Mm-hmm.
back month is more expensive than the front months,
Mm-hmm.
which makes sense, because if you
There's
own
more
oil,
uncertainty. Yeah.
yes, and if you own oil, there are storing costs.
Oh, okay. There you go. That makes sense.
So if you buy the physical oil, you have to store it some, and this costs you money.
Right.
So the longer the time is out for the future, you're saving the storing costs, but you're losing some money if you roll your futures.
Mm-hmm.
There's always a trade-off. There's no free money. So and these ETFs, which are built around futures, tend to go down over time
Mm-hmm.
because of the rolling costs.
Mm-hmm.
And so I stay away from this ETFs. And why do I trade this 5 underlyings? Because they are the most uncorrelated.
Oh, okay. And that's really important whenever you're building your portfolio. Absolutely.
Correlation risk is a big deal. So don't think you will invest in the SPY, in the Nasdaq, and in the Russell 2000, and then you are well diversified, because you have 500 companies in SPY and you have 100 companies in Nasdaq and 2,000 companies in the Russell. No, you are not diversified, because they move along they have a correlation about 90 or 95%.
Right. Absolutely. I mean, you are diversified in the fact that you've got the built-in diversity of each security, but on each of its own, they're not going to act independent. They're all going to move together. Yes. And whenever you're building a diversified portfolio, you want to have some things that go up when other things go down, and hopefully the combination of all those leads you in a positive direction.
Yes.
So, Stephan, I really appreciate you coming on to the podcast. This is really exciting to me to get to speak to the author of If You Can Order Pizza, You Can Trade. This book I highly recommend. Like I say, Stephan sent me an advanced copy. I had a chance to read through the entire thing, both that and the bonus chapters. They certainly go hand in hand. So if you get one, make sure you get the other. And it literally is a guide on how to trade options. He doesn't go too much into stocks because he's an options trader like myself. And I mean, it even says in the subtitle here, a mechanical approach to options trading. So be sure to check that out. Use the links down below for easy access to that. I'll put the Apple, Amazon, and Barnes & Noble and Google links out there. Make sure to check out Stephan on Steemit as well as Twitter, and I'll put the links for that as well. And he was telling me earlier that he's working on his next book, which means we're going to have him absolutely on the podcast in the near future to talk about that one too.
So the next book will be more on popular economics. It will be a book on money and interest rates, because you always hear, especially on Zero Hedge or Twitter or something, the Fed is manipulating the markets, and there should be gold-backed money, and banks create money out of thin air and something like that. And it is really not true.
Well then we will have him to come on and be our Mythbuster. Perfect.
Yes, it's a Mythbuster book. I think I have the chart, the euro-dollar futures chart. You have to look at the euro-dollars futures chart, because euro-dollars have nothing to do with the euro currency, but it's US dollars held outside the US. So in Europe, but they can also be held in Asia or South America or something. And the Euro-dollars futures chart shows you the short-term interest rates.
Okay.
So this interest rates should be affected by Fed decisions. And I did put it out several times on Twitter, this chart, and it also was on Tasty Trade, because I sent it to Tom and he liked the chart and then he put it on the show.
Oh, nice.
It was in late December. There were 3 rate hikes from June until December. And after the 3 rate hikes, the interest rate, the yield on the euro dollars should be higher.
Right.
But it was exactly the same as before the 3 rate hikes.
How about that?
So what about the Fed? What power has the Fed?
Mm-hmm.
And yes, I'm going to prove everything. And I mean, interest rates started to go down in the early 80s.
Mm-hmm.
The 10-year Treasury yield was about 18 or 19% in 1981.
Holy cow.
And from this time until now, it moved down and moved down and moved down and moved down.
Mm-hmm.
And when did the Fed start QE? In 2009.
Right.
So the interest rates went down from 18% to 3 or 4% without the Fed.
Mm-hmm.
And then they moved down a little more. During the time the Fed did QE.
Mm-hmm.
And everyone says, oh, it must be the Fed. The Fed was it. But the 12% before the Fed even started QE.
Right.
There are several reasons why interest rates go down, but one major reason is in the West is definitely demographics.
Really?
All our societies get older.
Yeah.
A lot older. Old people don't borrow money. They don't build companies. They don't build homes.
Mm-hmm.
They have money in the bank account, but they don't borrow as much as younger societies do. So that is, in my opinion, one. And there are a lot of studies out there to prove it. That's one of the major reasons why interest rates go down, not the Fed. So this will be my next book, and then there will be a third book about trading, like a workbook or something. I'm not sure yet.
Oh, okay.
I think I will something like I'm collecting lots of trades, and maybe I put in about 100 trade examples, 50 which went wrong and needed management and adjustments, and maybe 50 trades who went well, something like that. I'm not sure yet, but there will be a third trading book, of course.
That is exciting. Okay, people, you heard it here first. Stephan's going to be back on. Going to be talking about at least 2 more books. So I'm really excited to hear that. So, so Stephan, again, thank you so much for coming on today's How to Trade Stocks and Options podcast.
Yes, thanks for having me. It was great fun and a great honor.
Oh man, the honor's all mine, really. I tell people all the time it's just me talking to my phone. So now I actually get to talk to another human. So that's nice. Perfect. So that wraps up today's How to Trade Stocks and Options podcast. We give you the tools, tips, and tricks to help you trade faster and trade smarter. And make sure to come back tomorrow for the next episode.
Hey, thank you so much for listening to today's How to Trade Stocks and Options podcast. I know you're a listener, but are you a watcher? Make sure you head on over to YouTube, type in 10-Minute Stock Trader, and subscribe to the 10MinuteStockTrader.com YouTube channel. Every week, I upload all the podcasts as full videos, and that way you're getting the full 10-minute trading experience. That way you can have all the tools, tips, and tricks to help you trade faster and trade smarter. Make sure you subscribe to whatever podcast app you're listening to, and leave me a 5-star review if you don't mind. That would be fantastic. And whenever you're done with that, head on over to 10MinuteStockTrader.com and download the 1-minute options trading quick start guide. It'll give you all the tools, tips, and tricks that I use in my own portfolio, and it never gets outdated, and it will apply to every single options trade out there, so I think it'll be pretty useful for you. And while you're there, check out the free portfolio page. That'll show you everything that I've traded over the last year in full transparency. And since you're on the website already, check out the free trading course. In this free trading course, I give you every single thing that I know and use in my own portfolio, and I definitely think it'll help you out too. And then, after you're done there, head on over to tastyworks.com and sign up using the code 10MINUTE, that's 10MINUTE, and I'll send you over $150 in free 10-Minute Trader exclusive bonuses from 10MinuteStockTrader.com. And most of all, thank you so much for letting me be a part of your day. I really appreciate the fact that you and I have connected today and that you've chosen to put me inside your earbuds. That means the absolute world to me. And thank you so much for stopping by. 10MinuteStockTrader.com content is for information and educational purposes only. It is not, nor is it intended to be, trading or investment advice or recommendation that any security, futures contract, options contract, transaction, or other financial instrument or strategy is suitable for any person. Trading securities can involve high risk and the potential for total loss of any funds invested. 10MinuteStockTrader.com and Christopher Uhl, through its content, financial programming, or otherwise, does not provide investment or financial advice or make investment recommendations. Investment information provided may not be suitable for all investors and is provided without respect to the individual investors and audience's financial sophistication, financial situation, investing time horizon, or risk tolerance. 10MinuteStockTrader.com and Christopher Uhl are not in the business of trading securities trades, nor does it direct client commodity accounts or give commodity trading advice tailored to any particular client situation or investment objectives. 10MinuteStockTrader.com and Christopher Uhl are not licensed financial advisors, registered investment advisors, or registered broker-dealers. Stocks, options, futures options, and other financial instruments not included here involve risk and are not suitable for all investors. You alone are responsible for making your investment and financial trading decisions, and for evaluating the merits and risks associated with the use of any financial security and broker platform. For more information, please visit 10MinuteStockTrader.com/legal. And thanks for stopping by.